Well, hello there. Welcome back. It has been a minute since we've done an Harmless Wealth rundown. It is, today is the 12th, Sunday, March 12th. Recording this to go out on the 13th in the Harmless Wealth rundown. Great to be back doing the weekend review video. Tons of information to talk about this week. So let's just get right to the headlines that may or may not be impacting your financial plan and portfolio. And there's really two big things. The biggest being Silicon Valley Bank. We're going to get to that in a second. But before we get to that, last week was a tough week in the markets. And you know, I don't love talking about markets all the time, but nonetheless, last week we basically saw the markets give back the gains that we had year to date. Now we're still up on most of the indexes, the S&P, the NASDAQ, still up a little bit, but we were off to a great start to the year, and last year we gave a lot of those gains, or last week we gave a lot of those gains back. All part of investing, but something to pay attention to. Part of the reason, one of the storylines playing into it is Chairman Powell coming out at a testimony having some strong language about inflation and the current employment numbers and interest rates and where things are, and talking about still planning on raising rates, maybe 50 basis points was what he was talking about earlier in the week. By the end of the week, we were hearing about maybe 25 basis points, and maybe over this weekend, we're hearing nothing. So we'll see, but nonetheless, the language was stronger. It wasn't really a big Fed meeting to be expecting the comments that he had, and that kind of shook the market a little bit and leading to selling off in the market. So again, day-to-day movements in the market don't impact what it is that we do at Harmless Wealth. So for those clients watching, but just big picture, my philosophy on investing is you're buying, you're allocating, diversifying for the long run. The ups and downs from day to day may seem like big stories, but when you scale back over time, we tend to be good as investors over the long run. Very important to make sure that if you have short-term needs, where do those sit? Are they tied to the market? Do you have enough for monthly income needs? Do you have enough for things coming up down the road? And planning things that way, which is all why having a plan to guide where your money goes and aligning that with your risk tolerance is so important. So did want to make sure we acknowledge that, just because it was a few days in a row of the markets being down, but we've all been through this multiple times, and that's nothing abnormal. So the big headline, the one that I've been paying attention to more than I probably should have over the weekend, was Silicon Valley Bank going under on Friday. The FDIC came in on Friday to take over the bank and beginning to distribute assets to the depositors of the bank. So a lot of information out there. If you're on social media, a lot of fear-mongering, a lot of talks of bank runs, which is basically what happened to Silicon Valley Bank, happening beginning this week. A lot of bad information out there. A lot of pictures that are saying they are bank lines but aren't even from now, and you just have to be careful about the information that you get. And we live in this time where information is abundant, and that could be a good thing, but it can also be a bad thing, because it could be misinformation. It can be information shared with intent to benefit the person sharing it more than it is you, and usually calmer heads will prevail. So let's get to Silicon Valley Bank. High level of what happened. Have to start back with what the bank is. So Silicon Valley Bank is just that. It's a bank. It's the 20th largest bank in the U.S. I saw 16th as well. So 16th to 20th. It's a big enough bank in the country that it matters, but not so big that it's impacting us, especially those of us here in the Midwest, at least with our deposits. You know, we may have some corollary connection to them through some of the funds, ETFs and mutual funds we invest in, maybe have had that stock, or maybe you work for a startup or a tech company and they're affiliated with it through their banking. So its fingerprints go throughout the country, but it's not a bank that you think of when you think of your deposits and where they sit. But what we can learn from this is really, really important. So this is a bank that, with the name being Silicon Valley Bank, was based in Silicon Valley, was the go-to bank for a lot of startups, venture funds. Having your bank accounts having your bank accounts at SVB as a startup was kind of like a rite of passage. So they dealt with a lot of up-and-coming growth companies who were investing money into their tech companies to grow, and venture capital funds placing money there, putting their investments there to help these companies. So you have this bank that specializes in tech companies for the most part, not only tech companies, but a lot of tech companies. And if you've paid attention to the market over the last year, those tech companies, whether they are public or not, are the companies that are getting hit the most in the market because of interest rates going up. Tech companies tend to borrow a lot to put into their company to grow, and when borrowing costs go up, it impacts those businesses first. So growth stocks as a style of investing get hit hard when interest rates go up, harder than most of the other stocks, and this is where Silicon Valley concentrated a lot of their relationships with companies. So you have that beginning to go. On top of that, if you think about a startup, they are pulling money out of their accounts regularly to pay payroll, invest into the company. So there's a lot of money coming out when money goes into the bank. It's a little bit different than your local bank or a bigger bank where you and I keep our savings and it sits there until we hopefully never need it for an emergency, but it's there. These accounts were being used in and out for payroll and other things as companies grow. So you have money coming out. You have companies being hit, maybe getting less money from investments as the very aggressive investing in startup companies kind of calmed down for a little while. If you think back 2 or 3 years ago, you had these high-flying companies valued very high, money was very cheap, so investments were being made, and now that money is more expensive, people are more careful where they put their money. So now these companies might even get less money going in, so seeing these balances drain down. So you've got a bank specializing in high growth companies getting hit because of where we are in the economic cycle. They were already pulling a lot of money out, but they may not be getting enough money to go back in because investing is slowing. And then we get to learn how banking works. And this time is a little bit different because the last time we learned about banking was during the Great Financial Crisis. And those were big banks all over tied to real estate. That is not what this is, at least not the big banks that we know of. And it's also not tied to real estate. This is a lesson in how banks make money. So if a bank is just going to hold cash to reserve for you and I or businesses to use, they're not going to make any money. And we know banks have to make money. They have people to pay, buildings to pay electricity. So they go out and what they do is they take our dollars and they go out and invest it. They invest it in, sometimes in other companies, but usually the reserves to pay for the deposits have to be relatively conservative. And there were a lot of restrictions and regulations put on banks coming out of the Great Financial Crisis. And what SVB did, Silicon Valley Bank did, was they went out and bought treasuries, which is a very conservative investment, but they bought treasuries that were out 10 years or longer. And when they were buying these over the last couple of years, interest rates were really, really low, 1% or less. And if you've been in a meeting with me and we talked about bonds, when interest rates go up, the prices of bonds go down, which is not a big deal if you don't have to sell it. Because as a bond works, as you know from experience, you buy a bond, you invest in it, you put $10,000 in, you get an interest rate. And if you hold that bond till its maturity, you get your $10,000 back, assuming the company is there or the organization is there. So if we're buying treasuries, that's the US government, if you hold that for this 10-year term, then you get your money back because the US government is going to be there, knock on wood, to pay you back. So the fact that the bond prices go down is not a big deal unless you have to sell it. And this is where things started to go. Basically, the prices of the bonds were down that SVB was holding. So what they had to do to raise some funds was they sold part of one of their portfolios that is meant to be sold in short-term needs. And when they did that, they also added that with a equity raise, which is basically going out and raising equity for their company, for the bank, to kind of offset things. And when this happened, it's kind of sped up the awareness of looking at the balance sheet of the bank and where things are as far as the reserves for the deposits. And what exasperates this is earlier in the week, another bank went under, which was a bank that was very heavily into crypto. So it doesn't even really play, but now you have a bank that was heavily related to crypto, close up. They gave all the deposits back. No one was out any money, but just shut down because of what's going on in the crypto space. That bank goes down. Now SVB is doing some things that makes investors a little nervous. People start paying attention to it, and then people start pulling money out of the bank. That's normal sometimes. They have reserves there to pull out. But then you had some people, venture capital people, go out and start recommending that they're in companies they've invested in pull money out. And some of them even took to social media to say they were recommending people take their money out of SVB. And that created the bank run. If the bank run didn't happen, then there's a very good chance that the reserves were all there, everything would have been fine. But as we know from It's a Wonderful Life, when everybody wants their money out, it causes a problem, which then forces SVB to have to go look to sell more of their bonds at a discount losing money, and which brings in the problem. So things had gotten so bad, $42 billion was pulled out of the bank on Thursday or Friday. I think it was Thursday because the FDIC came in on Friday. $42 billion was taken out, which meant that as that kept on going, they would not be able to meet demands and be a big problem. So the FDIC came in, shut the bank down, took control of it, and beginning Monday, they're going to be giving the $250,000 FDIC insured limit to bank customers. Now, over the weekend, there is tons of stories and narratives and what ifs and all these scenarios painting a picture that's going to create more bank runs potentially, encouraging people to do so, and that's not going to be the best thing to happen. SVB, while it is a big bank and it is a problem, is not the representation of all of the financial markets that we know of. To the best of our knowledge, because they're publicly traded companies, Chase and all the big banks are sitting on the appropriate amount of reserves and in good shape. Now they have done the same thing. They've taken some of our cash and they've gone out and bought treasuries and mortgage-backed investments and things of those lines to make money, to pay us interest and run the business, but they have the reserves they need to be. There's no need to go take all of your money out of the bank. But as we see with SVB, when people start to panic, you don't want to be the last depositor to take your money out of the bank, because if the bank doesn't have it, then you get nothing. So is this a canary in the coal mine? I don't think so. I don't think that there's a need to go take all of your money out of your bank. Understanding what the limits are, FDIC insurance insures up to $250,000 in cash in a single bank to a single owner. So households could get up to $500,000 of cash. And there's other ways to put your money into money markets and other areas. If you have an investment account, like at TD Ameritrade or Schwab or Fidelity, those have a different type of coverage for the money markets called SIPC. Those have higher limits. There's plenty of ways to protect it to prevent you from feeling like you have to go take all of your money out. But nonetheless, people are emotional, people are irrational sometimes, and it can lead to things like what happened with SVB. So that is a big thing you might hear about. Maybe you haven't heard. Again, SVB is a very niche bank, very focused in the tech center. Silicon Valley is the location. If you're not in that space, you may not even heard about it other than a little blip on the news. FDIC is coming in, taking care of it right now. I've been looking to see if there's any updates. They're looking at trying to have some of the other banks come in and buy it, have a backup plan. A lot of talk about them making sure that all of the depositors get their funds back, because it wasn't the depositors that did anything wrong. It wasn't the small businesses, it wasn't the startups that did anything wrong. They put the money in the bank. If you're running a multi-million dollar, $100 million business, you're going to have more than $250,000 in a bank for payroll and regular expenses. So it's not surprising that over 90% of the funds in SVB exceed that limit because of the nature of who their clients were. So they're talking about making sure those deposits are all good. At the end of the day, in the past when banks have failed, the depositors have been made whole. It's the bond holders of the company, it's the equity, the stockholders of the company that see their money go down, which is the way it should be if you think about a business is structured to fail and capitalism works. The stock and the bond holders are investing, they're taking risks to get higher than average returns, and when things go south, they're the last ones to get paid back. Bond holders get paid back before the shareholders of the stock get paid back. So I think this is a very obviously serious situation for those businesses, and the spill out from there. You've had payroll companies not be able to run payroll because they flow through SVB while things are going on. We'll know a lot more tomorrow. I think we'll know a lot more Sunday night after I finish recording this and get the newsletter ready to go out for Harmless Wealth clients. But I think calmer heads are the way to be. They usually prevail. Don't overreact. Understand what it is that you have and where it's at. And if you happen to have more than $250,000 in a single account at a single bank, then maybe beginning to look at, can I structure my accounts in different ways? Can I put a husband and a wife, two separate accounts to get to that 500? Do a joint account, have it up to 500? How can you protect what it is that you have so that if something like that happened, while it may be inconvenient, you would be okay and protected and be guaranteed to get your money back through the process. And then above that, maybe you move things around. So again, I wanted to talk about this because there's a lot of scary headlines there, a lot of doom and gloom painting there. This is, unfortunately something that could lead to unemployment ticking up, which is what the Federal Reserve wants. But there's a lot of moving pieces here that go on, and the high level is, yes, a bank went under. There was a bank run that was exasperated by social media telling small businesses to go pull their money out, which makes me wonder what were the motives of the individuals going out there. I've been around long enough to see that Wall Street is greedy, venture capitalists can be greedy. I wouldn't be surprised if as time goes on we find out some of these individuals who are out there making these claims had a way to grow their portfolio off of the demise of Silicon Valley. And the other thing is, it's kind of sad because this is a bank that all of these tech companies got their start. Other banks wouldn't necessarily work with them because of the nature of their business, and they were there for the tech companies and the startups, and now when they needed people to be calm and not flood and pull all their money out, those individuals pulled all their money out, which I understand. You've got to take care of yourself first, but at the same time, it's kind of sad to see the loyalty change so quickly. Be there for me, but then when you need me, I'm not going to be there for you. But such is business from sometimes. So anyways, a longer than normal video, but I did want to spend some time on it. Again, what we learned from this week is, banks can have a bank run. It's not usually rational behavior to go take all of your money out of the bank, but once it starts going, it's hard to want to be the last person to not have your money come out, so you run in there as well. I don't think going to take your money out of your banks is the best thing to do this upcoming week. I think there's going to be a lot of fear-mongering that's going to be out there around this. There's going to be a lot of misinformation, a lot of people putting pictures out there. Double check, triple check the source of what it is that you're consuming to make sure it's valid and not fake. A lot of parody accounts on social media, just making stuff up for clicks and views, because that's the world we live in today. But learn a little bit about banking. Banks take our cash, they go out and try to earn more than what they pay us so they can run their business. In this situation, SVB went out and bought treasuries, which in itself is a very safe, normal investment to hold with cash. They have maturity dates. You know when the maturity date is. You earn interest. There's a lot of known there. But what they did not do a good job of was hedging against it for interest rates going up. It's almost like they thought interest rates would stay zero forever. There are things they could have done to hedge so that if interest rates did go up, there would be gains in another area to offset the losses on the bonds to be okay. That's what they're supposed to be doing. Why they didn't do it, we'll probably find out later on. But we learned about how we make money in our banks, how the banks make money, and what the risk is for holding cash. So as you can see, there is really no riskless investment or option out there. That's not meant to scare you. It's just the world you've always been living in, and sometimes we get glimpses into how things really work in the background. If I had to guess, I think FDIC insurance is going to come through on Monday like it's supposed to. I think a bigger bank's going to come in. It would be awesome to see the VC community come in and say, hey, we don't need government help. We're going to go ahead and we're going to take care of things ourselves. We have plenty of cash. We can help get people through as FDIC goes through. Liquidate SVB's holdings. Give the money back to all the depositors, and everybody's in good shape, but it might just take a little bit of time. The good news is they'll get money on Monday to ride this out. And then hopefully those startup companies can go out to some of their investors, which as a early stage investor, you're supposed to be there to help your company you believe in and give them more money in events like this. So a very interesting thing. It won't be the last we hear about it. And unfortunately, it starts the best week off of the year on a down note because it's March Madness week. So we've got the March Madness tournament starting, which I can't wait for. One of my favorite times is working on the Thursday and Friday, a lot of administrative work, maybe 1 or 2 client meetings squeezed in between the games, watching the games while I work. So it'll be a good time later on this week. But nonetheless, Monday will probably be a day full of scary headlines, and maybe not. Maybe everything gets solved tonight after I hit record, and Monday is just a normal day with a little bit of inconvenience for those directly involved with SVB, but we don't see it spreading out to anywhere else. So with that, I want to thank you for your patience as an RLS Wealth client if you're watching this as I get the rundown back into order. I love the new format. Hopefully you do as well. If you happen to be watching this as an outsider to RLS Wealth on YouTube, thanks for watching and tuning in. I'm still going to put these out, but as you notice, there is no more mixtape, at least right now. I've decided to take my energy and creativity to the daily notes, to the On Our Pursuit podcast, to the next episode podcast with my dad, and focus those energies there. There are plenty of great curation places out there to find great articles. From time to time, if I feel a need to share, I will. But it's going to be the weekend review video, and I'll put on the podcast as well. So that is it for this week. So I hope you have a great weekend. Have a great week coming up. Enjoy the games. Calmer heads will prevail. And remember, this is only a blip on the radar. It's not the first time we've seen some scary headlines. Won't be the last time either. So thanks for tuning in. Have a great week, and we'll see you all in the next episode.